Another sell-off on Wall Street following a key inflation report. Consumer prices are still on the rise as the Federal Reserve hints at more interest rate hikes. Your 401ks may be impacted by these trends. We're going to get into all this because tonight we have Kendall, the president of Kendall Capital in Rockville, Maryland, joining us. Thank you so much for being here.
Oh, thank you for having me. It's a wonderful night.
Yeah, I mean, today was, a reminder. Inflation remains hotter than hoped. Stocks closed out their worst week since, early December. Walk us through this inflation report.
So today's inflation report is the core CPI index minus food and housing was higher than expected, even though the last 6 months were being tamed. So this is some consider an anomaly of what the Federal Reserve has put in place already.
Yeah, you know, the Federal Reserve has been hiking up those interest rates, which in hopes of bringing down inflation, but it could also raise the risk of a recession because they slow the economy. It could hurt stocks, other investments. Where are we with that? Do you feel like the Fed is still going to be raising those rates?
The market's consensus is the Fed funds rates will be raised. They expect the Fed funds rates will go 5.25%. They have made it quite clear they want to put their arms around this inflation and bring the inflation down to an annualized rate of 2%.
So what does this mean to the average American right now that is obviously dealing with high costs across the board? How are they feeling the impact of this, and what should they be expecting over the next 6 months?
Good thing. Well, you just had on your news segment, housing prices are starting to slow down. Even our Netflix accounts are coming down in prices. So it takes a while, as I like to say, to steer the cruise ship. You know, you can't just turn it on a dime. So what should investors expect? I think this is going to take longer than many of us were expecting. It's going to probably be not this first quarter, probably second or third quarter before we really see inflation come down.
And what do you tell investors worried about their 401k retirement savings? Is it one of those things like just don't touch them, let them be?
Well, it is interesting. They call this the rich man's recession because it's the 401ks and financial assets have come down in value. People haven't really lost their jobs yet. Unemployment's only 3.5%. I do think what has gone on is interest rates have dramatically moved up. 2- and 3-year treasuries now are over 5%, highest they've been in over 15 years. I think there's great opportunities in the fixed income market that we didn't have just 18 months ago. We also need to be conscious as far as kind of those high flyers. I call them the Nifty 50, stocks that are trading at huge premiums like Tesla, Alibaba, Netflix. I still think they're very expensive. Don't pay a premium for owning those type of securities in today's market.
I know a lot of folks are looking to buy their new home. They want to do investments. You know, it's tough right now. Everything is so expensive. As someone who is an expert in all of this with your years and decades of experience, what would you suggest to someone who wants to save a little bit of money, invest in something, or even buy a house? What should be the game plan?
Well, no two investors are exactly the same. I do think you need to look at the premise that long-term stocks and real estate beats bonds and cash. So you need to be prudent. If you're going to buy a house, it shouldn't be a 6-month investment. It should be something that you want to live there, enjoy life with for the next, 5 to 10 years. If you're going to buy stocks, you're not buying it for what's going to happen at the end of the year. You're buying it to fund a retirement account or to send a child to college. So the mindset needs to be long-term. And remember, we just went from, in 18 months, from a Fed funds rate at 0.25%, which was the lowest in 50 years, now to a Fed funds rate that's going to be 5.25%, the highest it's been in well over 20 years. So we've had dramatic moves in the financial markets to bring this, gorilla down, inflation, and I think it's the cost of managing through the pandemic.
Yeah, and before I let you go, I know a big question a lot of people want to know, when will those interest rates come down, and will we actually hit a recession?
I don't think they're going to come down anytime soon. I would not see the Fed cutting interest rates within this year, quite frankly. And remember, historically, the Fed funds rates has been, 0.5% to 1% higher than inflation. So from that perspective, it's going to take a while for this inflation gorilla to be to be tamed in today's market. So it's a different market than we had a year, 2 and 3 years ago.
Yeah.
And we need to manage through it
We have to pack our
be
patience.
accepting of higher interest rates.
Yeah, we got to be patient for now. Clark Kendall, thank you so much for your expertise. Have a great weekend.
You too. Enjoy the weekend.
Thank you.